right, looks like we are live again for another live stream show. Another day and another new scheme by the large US banks has been uncovered where they are getting artificially cheap currency and credit to make an absolutely enormous profits to front run the Federal Reserve Bank that is buying these assets, and I'm using air quotes, that the banks bought beforehand, knowing full well that the Federal Reserve Bank would buy them from the banks at a big, big profit. So the banks don't even, and this is the mistake that a lot of the deflationistas and others make, is the banks don't even need to make regular loans into the economy anymore to make billions of dollars in profits. The banks can manipulate markets. The banks can rig markets. The banks can front run the Fed. The banks can leverage up on trades on bonds. They can leverage up trades on derivatives. They can leverage up trades on currencies. They can get a refill of reserves to go back to the casino if they blow up. They can make more money, tens of billions of dollars in profits. The majority of banking profits for over a decade now have not been made by the large banks through loans. They have been made through the casino, through trading derivatives, through trading leverage bond trades, front-running bond purchases that they know the Federal Reserve Bank or the European Central Bank or the other central banks are going to buy. These banks are not really banks. Now, the ability there's too much rules, regulations for a lot of the banks now to do a lot of lending into the economy, and the profit potential is just not there, especially with the central banks manipulating interest rates and the yield curve the way it is. It is far easier and far more profitable. Plus they get bailouts. They get to keep the profits, and the losses are socialized by the savers if the banks act as hedge funds. If the banks go and make big bets on bonds, leverage bond trades, leverage currency trades, and leverage derivatives trades. And thanks to Reuters, which came out with this very interesting article on October 9th, we have a new profit-making scheme that the US banks have been up to. So Reuters came out with this article. You can see it there on your screen. Treasuries on steroids. US banks mortgage bond trading bonanza. Wall Street banks are on track for a record year of revenue from trading U.S. government-backed mortgage debt. So they're not loaning into the economy. They're trading bonds that they know they're front-running the Federal Reserve, because the Federal Reserve is going to buy these things. The Federal Reserve has been buying a lot of these things. I just, right before I started the live stream show, went onto the St. Louis Fed website. And yes, the official Fed balance sheet has not really done that much lately. However, the underlying types of assets, and I'm using air quotes, the types of assets that the Fed has been buying has changed. So the amount of mortgage-backed securities the Federal Reserve Bank now owns has changed drastically. So since Wednesday, March 4th, when the Federal Reserve Bank owned $1.371846 trillion worth of mortgage-backed securities, the Federal Reserve Bank now, according to its own website, updated October 8th, owns almost $2 trillion in mortgage-backed securities. That is a net change of, I did the math here with a calculator, $610,943,000,000 in additional mortgage-backed securities the Fed has bought. These are mortgage-backed securities that the large banks knew beforehand that the Fed was going to buy. So they bought them up like crazy months ago, knowing that the Fed would pay a higher price for them. Again, this is a money-making profit scheme that the banks do not have to do loans into the real economy for, because they know it is basically risk-free. They can leverage up these bond trades that the Fed will go and pay full price or higher in some instances, because the Fed owns officially according to Bloomberg News, over 22,000 different assets and securities now. And a lot of them are bonds and corporate bonds and mortgage-backed securities and other toxic garbage that's not really worth the official nominal value, the official par value. So back to the article here. The Wall Street banks are on track for a record year of revenue from trading U.S. government-backed mortgage debt, industry sources told Reuters, amid a surge in demand from the Federal Reserve in its battle against the pandemic and from investors hunting yield. Revenue from trading bundles of home loans at the biggest global banks, including JP Morgan, Citibank, and Goldman Sachs, among others, is expected to top $3 billion in 2020. One source with direct knowledge of the bank's trading revenue said, besting last year's peak of $2.5 billion. The source declined to be identified because the data isn't publicly available. So it sounds like this source leaked the information to Reuters because it is a scheme, because it is rigged, because the banks have figured out a new, along with the Federal Reserve, the large banks and the Federal Reserve combined, and the U.S. government and the U.S. Treasury have figured out a new profit-making scheme for the banks where they don't actually have to lend into the real economy. The source declined to be identified because the data isn't publicly available. Quote, buying mortgages in March was one of the best trading opportunities in mortgages since the last financial crisis, said Daniel Hyman, head of agency mortgage-backed security portfolio management at Pacific Investment Management Company, or PIMCO. That's the company that Bill Gross founded, the former bond king, and then was kicked out of. The surge in demand and activity has also allowed new names to enter the space. Bank of Montreal. This is a Canadian bank now involved in this scheme. I guess they figured out, I guess they got friends at JP Morgan and Citibank and the others. They're like, hey buddy, you got to get in on this scheme. It's easy money. You can leverage this trade up. It's easy bonuses. Bank of Montreal, which acquired mortgage security broker-dealer KGS Alpha Capital Markets in 2018, is now actively trading residential mortgage-backed securities, or RMBS, according to the source. So it sounds like the Federal Reserve Bank and the U.S. taxpayer and holders of dollars are now helping subsidize profits for the Bank of Montreal, too, in this new profit-making scheme for the banks. Bank of Montreal and JP Morgan did not respond to a request for comment. Goldman Sachs and Citibank also declined to comment. Of course they're going to decline to comment. They're laughing. They're laughing like, how long did it take these morons to figure out that we're making all this extra money from this scheme? It's just so much easier for them to manipulate markets and rig it and to make hedge fund trades, because with the whole thing is with the reserves. If they screw up on these derivative trades or these leverage bond trades or these leverage currency trades, the Fed just gives them more reserves, and then they can go right back to the casino and start gambling again. The trading boom, so they don't have to lend into the economy. Plus, the Fed was paying them interest on reserves. So the reserves just stayed there, and then they could go to the casino and gamble to their heart's content into the trillions to make tens of billions of dollars in profits per year. So why do you think that they don't really need to lend into the economy? Because they can go gamble at the casino. And it's heads we win, tails you lose. Profits are privatized. Bonuses for the employees, the traders, and the managers and the higher-ups at the bank, if they hit the earnings per share, if the traders make a big trade, and if something blows up and needs a bailout, no one goes to prison. That's how messed up things are. The trading boom is likely to provide a silver lining in an otherwise tough period for U.S. banks because it's a rigged scheme. Because the U.S. Treasury and the Federal Reserve always figure out new schemes with combined with the large banks to help make sure that they can make profits. Normally not by lending. Period for U.S. banks, not by lending into the real economy. U.S. banks amid record low interest rates and rising bad debts. They start reporting third quarter earnings next week, with JP Morgan and Citibank kicking things off on October 13th. The Fed's global pandemic stimulus measures, and they're really bailouts, are responsible for the rally in mortgage bonds guaranteed by the government agencies Ginnie Mae, Fannie Mae, and Freddie Mac, say investors. The premium that investors demanded to hold these bonds over risk-free, and the article says risk-free, that's not really risk-free, Treasury debt, especially if the dollar is devalued, as measured by the Ginnie Mae, Fannie, and Freddie mortgage-backed security ICE Bank of America indexes. I guess that's a bond index Bank of America came up with. Is that the MOVE index? Were the widest since 2007-2009 financial crisis in mid-March. No, I don't think that's the MOVE index. I think that's another one. That was just before the Fed. The MOVE index is a bond volatility index, though. That was just before the Fed announced it would increase its holdings of the securities, which are known as agency RMBS. The two key letters are RBS. Since then, the Fed has bought more than $600 billion of agency RMBS, and the spreads have narrowed by more than 50 basis points. Okay, there's some interesting charts here. U.S. mortgage trade was golden opportunity, but the Fed isn't the only one buying. Demand for safe haven assets jumped when the pandemic first roiled financial markets and has persisted since. Investors have rushed into agency RMBS, which have the benefit of government backing while also offering a higher yield than Treasury debt. Yields on Treasury bonds have fallen to all-time lows since the Fed cut interest rates near zero. Quote, agency MBS are treasuries on steroids, says Greg Parsons, Chief Executive Officer at Semper Capital Management, a hedge fund specializing in mortgage-backed securities. Some investors who bought heavily in March are making more than a percentage point in yields above the benchmark. According to investors, a huge return, especially if you use a lot of leverage, 10-1, a huge return in this rate environment. The PIMCO, so 10-1, leverage up 10-1. If those trades blow up, the Fed has your back. The PIMCO Ginnie Mae Fund has returned 4.59% in the year through August versus its benchmark at 3.32%. The prepayment risk, according to, average daily trading volume in agency RMBS hit a peak in March of this year. So people were buying low because they probably had inside information that the Fed was going to, if you look at the chart here, of the Fed's purchases of mortgage-backed securities, it's gone parabolic pretty much since mid to late February and early March. It's absolutely exploded. The chart here on the St. Louis Fed website, I'll put a link to it below the video in the information and description section if you want to take a look at it afterwards, is crazy. Okay, agency RMBS differ from the... Average daily trading volume in agency RMBS hit a peak in March of this year, according to data from the Securities Industry and Financial Markets Association, and new issuance in 2020 stood at a record $2.6 trillion of new agency mortgage-backed security. Now, Christopher Whalen, who is a banking analyst, he is an institutional quality banking and mortgage finance industry analyst. He put out a very interesting blog article, and I'll link you to that below the video. It's from his blog post, Powell Fed Embraces Monetary Relativity, on September 21st. And the chart there is on your screen. So SIFMA, total bond issuance. The key one there is the green line and how it's going at a very high angle since February and March. And he says in the article, there's not a lot here where he talks about it because the chart, a picture with the chart there is really worth 1,000 words. But he basically says it's insane. The Fed is buying, $40 billion in agency MBS per month. That's what it says here in the article. And that now 400, notice that new mortgage debt issuance is now over $400 billion with a B dollars per month. That is how crazy. So the banks are the sausage grinders, the toxic sausage makers at the banks, the large banks and on Wall Street, are making more of this stuff because they know that they can dump it onto the Fed, worst case scenario. So it's easy money. Basically, it's risk-free to them. So they can leverage up this trade. It is easy. The hedge funds can buy this stuff. The hedge funds can leverage this up because they know that the Fed is going to buy it. So Wall Street is making even more of this toxic sausage garbage because they know the Fed's going to buy it. This is how bad things are with the corruption. This is a problem with big government. This is a problem with the Federal Reserve. And the banks just go from scheme to scheme to scheme, manipulation to manipulation to manipulation, casino game to casino game to casino game. Why do they need to make loans into the real economy when they have to deal with lower profit margins, tons of regulatory agencies, all these rules, regulations, red tape, and low profits? Oh, they can build bank branches and they can reduce taxable income that way. They can increase their costs. They can build some bank branches. They can collect some deposits. But the majority of their profit-making potential is in schemes like these that I'm talking about. Tons and tons of schemes. This is part of the Cantillon effect and stagflating tax and lie. The banks can make way more money manipulating markets, and I'm using air quotes, markets, participating in schemes like these with the hedge funds, and in gambling like hedge funds on leveraged trades, in currencies, all types of different bonds, corporate bonds, government bonds, and then derivatives. At this point, the banks make way, way, way more money doing all these different things than actually lending into the economy. For those of you saying that why don't the banks lend into the real economy, the profit potential is way larger for these other things I just mentioned. Agency RMBS differ from the non-agency variety, which gained notoriety for their central role in the 2008 financial crisis, so they're similar. If a homeowner defaults on a mortgage that is packaged into an agency RMBS, the agency, which is Fannie Mae or Freddie Mac or Ginnie Mae, makes up for that defaulted principal, and the taxpayer and the Federal Reserve Bank are backing those GSEs, government-sponsored enterprises. So Fannie Mae, Freddie Mac, Ginnie Mae. There were some rumors that they were going to be fully privatized. I just don't see that. Not if they're playing with these more toxic sausage derivatives, not if they're taking on more of this risk. Investors in non-agency RMBS, however, absorb the loss. Though defaults pose less of a problem, agency-backed RMBS do face a significant risk from borrowers prepaying the mortgage, which shortens the duration of the security, reducing the number of installments paid to investors. Prepayments increase dramatically when low interest rates enable borrowers to refinance loans. Semper Capital is not investing in traditional agency RMBS for precisely that reason. So they want to buy and not investing in traditional agency RMBS. Oh, so it can be prepaid off quicker for precisely that reason. Quote, if there's one specific issue that is limiting the return potential on the agency side, it is, but the agency side is also, there's a Federal Reserve Bank and U.S. taxpayer guarantee on that. Is that prepayment speed remains elevated, which on the non-agency side is a strong positive for credit quality and performance, but on the agency side is really holding back prices, said Parsons. But banks are likely to keep buying. Though they may be overtaken by the Fed this year, commercial banks are still actively the largest holders of agency mortgage-backed securities. Flooded with deposits during the global pandemic crisis, big banks have put that money to work in agency mortgage-backed securities, among other securities, bringing their holdings to $2.3 trillion. So the large banks have $2.3 trillion in mortgage-backed securities, according to Fed data. Quote, if you talk to a Wall Street firm, they're making huge money selling to banks right now, said Ken Shinoda, portfolio manager at DoubleLine, which is Jeff Gundlach's firm, which manages strategies that invest in both agency and non-agency mortgage-backed securities. Quote, there is just insatiable demand for agency mortgages by all the depository institutions, and deposits are up, savings rates are up, everyone is kind of hoarding cash. So people are looking around for income. They're looking around for higher yield. They're trying to find better risk reward than just buying U.S. Treasuries, because the yield curve on U.S. Treasuries it's been pretty tight for the majority of the yield curve. It hasn't moved a whole bunch. So there's not a lot of opportunity to make a lot of money on those types of government bonds right now, unless you're just looking for maybe capital gains later on. And normally what the hedge funds were doing was they were leveraging up those trades 10 to 1 with the risk parity, but now you're seeing a lot of articles coming out that a lot of hedge funds are starting to shut that trade down after they were bailed out in February and March, after a lot of them that were using leveraged risk parity, highly leveraged risk parity trades on bonds blew up and were bailed out secretly in February and March. But don't worry, no senior bankers are going to prison. The Federal Reserve Bank is helping make sure the large banks, its controlling shareholders, are going to make enormous amounts of profits in any scheme or manipulation or derivatives bet. And capitalism will get blamed for everything, because the average person won't even do 5 minutes of research to figure out what's going on. Welcome to dystopia. Okay, well, if you want to read more about this corruption scheme, I'll put the links below this video in the information and description section, but that's pretty much it for tonight. It's just very frustrating, but if you've been involved in these, paying attention to financial markets for a long time, all these additional profit schemes from the Federal Reserve and the large banks or other central banks, I mean, the bond fund managers and the large banks in Europe, the European Central Bank was doing the same thing. The Bank of Japan was trying to help out the Japanese banks, the large Japanese banks as well. So this is part of the game. It's part of big government, part of central banking, that they try to bend over backwards to come up with new schemes to help these large banks repair large banks and make sure that they can, if they get hurt in a financial crisis like what happened in Japan, or how European banks recovered a lot less after the 2008 financial crisis than American banks did, because American banks were recapitalized insane amounts with the bailout, with all the different bailout programs and currency swaps. Excuse me, the American banks were repaired with all these different bailout programs. The currency swap lines, a lot of them went to Europe. And still, European banks were in immense amounts of trouble because of their derivatives books. So it's just a mess. Unfortunately, the average person just doesn't understand what's really going on, so they just blame capitalism. But this is way more complicated than that. Because the government's involved in the profit manipulation scheme. The government's bending over backwards to make sure the banks can make all billions of dollars extra with all these schemes. And manipulating markets, and then going and trading at the casino. And if they blow up on some big bets, then they get bailed out. And the average person just blames capitalism for all this. But if the Federal Reserve and other central banks were there, would the banks have taken the risk? That's the big question. If they knew they weren't going to get bailed out, and if the bankers would have went to prison for fraud, would they have taken the risk? Because these senior bankers, I think a lot of them, they're pretty confident they're not going to go to prison. They're close to 100% confident. I mean, maybe like a couple mid-level guys will go to prison. And then like some few small traders, few low-level guys at a bank will go. I think one low to mid-level guy at Goldman Sachs went to prison for all the mortgage fraud that was happening in like 2008 and 9. And then for the precious metal market manipulation scheme, I think a handful of small traders and a couple of mid-level managers are going to do some prison time, and then no senior banksters at the large banks are doing any prison time, and the shareholders are going to be paying that $1 billion fine. Oh, it's a record $1 billion fine. Well, how much in manipulation profits did those large banks? Has anyone? I don't even think there's a reliable estimate out over the last 15, 20 years, because Gold Antitrust Action Committee has been covering this for about 20 years now. I think 1998 they started their website. And they've started documenting this stuff in a lot of detail. So if you went back that long, how much in profits have the large banks made from manipulating commodity prices, currency prices, London interbank operating rate, LIBOR, and the precious metal markets? So it's way more. The banks have made way more manipulating these markets than the $1 billion fine. And the average person will see, if they read it all, if they see the headline at all, the $1 billion fine, and say, wow, that was a big fine. The government did a great job. No. That's a tiny little fine relative to the amount of profits from manipulation. Okay, well, that's it for this rant and tonight's little live stream show episode. That chart, the picture is worth 1,000 words. Those mortgage-backed securities, that toxic sausage is exploding in amount, 400 billion per month now. So the Fed is buying, I think, about 40 billion per month of that. And if the Wall Street banks keep cranking out more, then the Fed will probably buy even more, because that's how the rigged game works. So the large banks can make more profits, so they don't have to lend into the real economy to make any profits.